Hey everybody, so I want to talk about investing in bond funds. We've been doing it for way too long and we don't really understand what these things are apparently. So let's make sure that we have a basic understanding so we know when and where to utilize bond funds as an investment in our portfolio. So let's begin with really basic understanding. What is a bond? Well, a bond is really the same investment vehicle as a CD or the ever so popular lately MYGAs, multi-year guarantee annuities. Ooh, that nasty word. But CDs are fixed rate investments with banks. You give them the money, they invest it however they want. They pay you interest. At the end of the term, they hand you back money. A MYGA, exact same thing, fixed rate investment, except with an insurance company. You hand them money, they invest it however they want, they pay you interest, and they give you back everything at the end. That's how it all works, okay? Well, bonds are basically the same thing, whether it's corporate bonds or municipal bonds or treasury bonds, right? These are all fixed rate investments. You hand the company, the treasury your dollars, they pay you interest, they invest it however they want to, and then they pay you back all the money at the end. Well, that's really all the same thing. CDs, MYGAs, and bonds are all basically the same type of investment. They pay a fixed interest rate for a fixed period of time. Now, the big difference between bond markets and CDs and MYGAs is one very basic, simple change. There is what I call a semi-efficient marketplace to buy and sell bonds. There's a very, very, very small, inefficient marketplace to buy and sell some brokered CDs. And there's no market to buy and sell MYGAs, multi-year guarantee annuities. Okay. So understand that the difference is the marketplace. So you can get a bond for 30 years knowing you're not planning on holding it for 30 years because you know you can just put it up for sale and wait for somebody to buy it. Now, that comes with pluses and minuses, right? The thing that people don't like about CDs and MYGAs is there's a penalty if you want to change your mind and take that money before the end of the term, right? So we don't like that penalty. So instead, this marketplace allows us to sell it without a penalty, or does it? And this is where you have to understand that difference. When we see rising interest rates, and we see this typically when we're seeing inflation, if we're seeing inflation, an overheated marketplace, they start rising interest rates to calm everything down. Well, guess what happens to your bonds? They become less valuable, right? Because if you bought a 4% bond when 4% was a good interest rate, and now they're paying 6% on bonds, nobody wants your 4% bond if you put it up for sale, right? That makes sense, right? If you own a 4% bond and everybody else can get 6%, nobody wants to buy your 4% bond. So the value of that investment goes down, which means, yeah, you're kind of getting penalized, right? And sometimes those penalties are way worse than any penalties with CDs or MYGAs. So understand the marketplace creates a fluctuating value of bonds. Now, when you have a mutual fund that's filled with bonds, it's at the mercy of this marketplace going up and down because of interest rates. It has nothing to do with the stock market. That's why we liked them. We liked them so much because as interest rates go up, the value goes down. But as interest rates go down, like it did for about 40 years, consistently from 1982 to, oh, say the pandemic, interest rates went down and down and down and down and down and down, and the value of those bonds went up. So not only were we making interest, but we were also increasing the value of that bond mutual fund as interest rates went down. And then we hit this little spike of interest rates. Everybody lost 20% in their bond funds. And well, haven't really made it back much yet since. Okay. So we have to understand those basics. These are all fixed rate investments. Your choice is a CD, a MYGA, or a bond. Those are fixed rate investments. Bond mutual funds are just simply a portfolio of individual bonds. Okay. So when we look at interest rates, because we don't care what the stock market does in the bond world, right? It doesn't really matter what the stock market's doing. It's not correlated to your bonds. Except when interest rates go down to zero, then the correlation really, really starts coming together. Okay. So here we are, 1982. To combat inflation leading up to 82, we kept raising and raising and raising interest rates, raising interest rates. And these little shaded areas are the recessions. See what happens typically when we hit a recession, the interest rates come crashing down. And then we hit the inflation and then the recession. Okay. And then we tried to bring them up and they went down, tried to bring them up, they went down. In general, when we see recessions, the interest rates go down. When we see inflation, interest rates go up. Okay, so I want you to think of that teeter-totter when you look at this and say every time we see interest rates go down, we're hitting a recession and the bond values go up. That's a good thing, right? We like making more money when things are going bad. Okay, I get it. But now when inflation hits, we raise interest rates and now you're losing money. And what's the biggest fear that a lot of retirees have? It's not keeping up with inflation. That's one of the big problems that we have with retirement portfolios, because the more conservative you get, the less you're going to be able to keep up with inflation, is what they always tell you. Well, I want you to think about that. If your only safe investment was bonds, then the answer is absolutely correct. How are you going to keep up with inflation if your only safe investment in your retirement portfolio is bonds? And bonds are absolutely designed to go down when interest rates go up. And interest rates rise when we see inflation. That's what the Feds have done forever. Okay, so we have to understand that. So you go through all these periods of time, you look how we got hooked on bonds. I want you to realize that bonds were terrible and not popular. There was very little corporate debt out there back in the 70s. This proportionally, very few bond interactions back in this period, 60s to 70s to 80s. And then all of a sudden, oh my Lord, the rocket launch in corporate debt, and honestly, treasury debt and every other kind of debt. As interest rates got lower and lower and lower, we figured out, hey, bonds are a great investment. Demand drove debt. People wanted it. We want bonds. We want bonds. We need them as investments for our portfolio because they don't have the correlation to the stock market, and it helps smooth out our growth in our portfolio, making it more reliable. So we used them and used them and used them and used them and forgot the fact that when interest rates rise, we lose value of our bonds. And when the interest rates arguably hit zero, whether you want to say 9/11, they hit a really low interest rates, and then a new low in 2008, and then holy cow, almost to zero in the pandemic. At some point, bonds became a return-free risk. You weren't making anything because interest rates were so low, and they'd been so low for so long that even bond funds had trouble finding ways to earn anything. The yield on bond funds was 1-2%. It was in the twos on most of them. And then we had the rocket launch of interest rates. And when I say rocket launch, we're really back to, early 2000s. It's not like we're that high in interest rates. We all feel like it's very high interest rates right now. Well, I'd love to go back to 1982 and buy a 30-year corporate bond so I could sit and hold it and make 15% interest for 30 years with very little risk. I think we would all enjoy that, but what did we have to pay when we saw those interest rates? Well, inflation was in double digits as well. It was quite painful. Okay, but the higher your interest rates, the longer you want to lock in that fixed interest rate. Okay, CDs are really for real short-term periods. You're talking 1 year typically. You can go up to 18 months, but anything longer than 18 months in the CD world, you got to make sure you know that they're callable usually, and there's a lot of other problems with them, and you have no liquidity. So then that's where MYGAs fill the gap. MYGAs, multi-year guarantee annuities, are their strength is more like 3 years to 10 years. And then the corporate bonds, that's when you're, or treasuries, that's when you're getting out to those much higher interest rates. So understand that these fixed interest rate investments are going to have their time and place, but don't get glamorized by these interest rates. They can go up. If we see inflation, yes, the Feds will push interest rates higher. They will. The thing that we found out very quickly is we are a lot more resilient. Not only our housing economy, but our business economy is a lot more resilient than we thought it was. We were very aggressive coming into that pandemic and rocket launching out of that. When they raised interest rates, the reality is we were combating some of this inflation because, well, financial whatever, throwing money out everywhere is really a problem and leads to inflation. So surprisingly, they combated it very aggressively, and it worked so far. And the housing market hasn't fallen apart, although it seems to be teetering a little bit right now. So when we look at bonds and bond funds, don't think we're out. That, hey, interest rates are back up and we can put all our money back into bonds now. No. Wait a second here. Look at the last 10 years. Okay, I always use BND because it's one of the biggest bond funds out there, and it's the most, I see this more than anybody else. It's the typical bond fund, and honestly, it matches the industry, the entire bond investing world fairly well. It does edge it out in a lot of cases. So BND is a good, temperature taker of what bond investing is. And really, look at this. Look at this. This is a return-free risk. I don't get this. 10 years of investing and you're only averaging 1.53%. Look, during these lower interest rate periods, I could still get 3% fixed rates out there. Why do I want to go through this garbage? 13% down when your big ups are 7, maybe 8% in a great year. Well, 2018, right at the end of the year, what we don't remember was the market completely crashed. And right at the beginning of 2019, they lowered interest rates. So that's what the push was here. And then 2020, we hit the pandemic, and holy cow, the interest rates plummeted to zero in 2020. Well, look at this. This is all we earned when we lowered those interest rates. You can only earn so much when you're working with almost no interest rates. So we climb that interest rate and we lose a bunch of money, and that's what happens. But look at this, returns. Nobody would be happy with this. 10 years at 1.5%, the 5-year is still negative, 3-year almost 2%. Yes, 1 year, the interest rates have come down a little bit, but boy, not much. That's behind the scenes. The Feds haven't touched the interest rates. So this may be temporary. We're watching it and keeping an eye on where interest rates are going. We've seen them edge up, edge down, edge up, edge down. The Feds don't control interest rates, okay? So just understand that we're going to have these ebbs and flows. There's going to be a good year here and there, but using this as a blanket safe investment, oh my Lord, that's a terrible idea. If anything, bond funds right now have fallen way out of favor. Maybe use some individual bonds. There are some ETFs out there with maturity dates, defined maturities. Those are kind of cool too. It's like having a full portfolio that all matures on the year that you want it to mature. So there are some fun, more innovative ways to do this than just in individual bonds. But bond funds, boy, you're really more using that as a speculation. You're speculating that you think interest rates are going to come down, and then you're going to sell them, right? Well, here's where the problem comes in. If this is your quote unquote safe investing strategy and you're waiting for interest rates to go down to sell your bond funds because you finally learned your lesson, what are you going to invest in when you sell these? Interest rates have gone down to zero, let's say, and then all the other safe investments out there are going to be garbage. So you have to think through that strategy. It doesn't necessarily make sense. Using bond funds, you need to invest looking at today going forward, not your history. Bond funds are going to come up and down and up and down and up and down, and they're going to flounder. As long as we're floundering around these low interest rates, and yes, right now we are still considered low. Wake me up and let me know when interest rates are double digits again, and I might go back to a blanket world of investing in bonds only as my safe investment. But I need people to understand, as you enter retirement, bonds can't be your only safe investment. You have to have other strategies, other safe, stable investing strategies in your portfolio once you're in retirement. You can go through the ups and downs when you're in your working years, of, the stabilizer in your portfolio, because your 401k doesn't really give you any other choices. But you got the time frame to deal with that. When you're retired, the only reason you need a safe, stable investment is because you're actually using your money, pulling it out, and you need a place to pull from that hasn't lost. That's the problem here. 2022 hits and interest rates jump. You've lost 13% in all your bonds. And oh, yeah, by the way, all your stocks lost that year too. Where are you going to pull from this year? Don't be that person that is enjoying retirement one month and hating it the next month and worrying you're running out of money. Or you just don't spend any money this year because your portfolio didn't do well. No, go enjoy retirement, whether the market's doing well or not. That's what your portfolio should be doing for you. And one of the first places you go to fix that problem is making sure you have safe investments in your portfolio that aren't getting hurt when the market's not doing well, or interest rates are up or down or sideways or anything. Whether things are going well or not, your portfolio should have a place to withdraw from without withdrawing from losses. And you can't rely on bonds for that purpose. Okay, so be careful. Larger portfolios with bigger, safe investing strategies in there. Yes, there can certainly be some bonds. Right now, lean more on the individual bonds, have maturity dates, things like that. You can do some of the quote unquote speculative side of the bond world, waiting for interest rates to come down, knowing you're going to sell that portion. But again, remind yourself, if I'm doing that strategy, then what am I investing in? If that allocation in your portfolio, you figure if interest rates drop, the market dropped, I'm going to sell those bonds that just made some money and put it in the stock market, there's a sound strategy. But don't tell me that's a safe investing strategy. That is a speculative market timing strategy. That is not your safe, stable investment portfolio strategy, right? So define what it is that you're doing and how you're using these bonds. And don't, as a retiree, plan on using this as your only safe, stable investing strategy. It doesn't make sense. All right, I hope that helps. I hope that's a good, solid discussion on using bonds and bond funds in your retirement portfolio. This is meant to be an eye-opener for people and to understand what it is you're actually investing in when it comes to bonds and bond funds. Really, their counterpart is the CDs and MYGAs. Those are all fixed rate investments, and they're all essentially the exact same investments. You're handing money to another entity. They get to go do whatever they want with it as long as they pay you the interest, and at the end of the term, they give you back your money. They're all the same. Bonds come with the difficulty of having a semi-efficient marketplace to buy and sell them, and that's the main difference between CDs, MYGAs, and the bond market itself. And that comes with good and bad. All right. When interest rates rise, the value of bonds fall. When interest rates fall, the value of bonds rise. That's the marketplace. That's because of the marketplace. Good and bad, that's what you have to deal with. And that needs to be fixed in your portfolio. All right, everybody, I hope that helps. Let me know if I can help in any way. Go to yourinvestmentcounselor.com. You can always book a free meet and greet. Yes, with me, actually me. I hear there's people out there that use this as a lead generation for their whole company. No. It is just me. I have a small firm. I enjoy educating. We do full classes every month. It's a different topic, and 3-4 chances a month to watch our classes. fpfeaz.org. You can also go to SES Web. We're working on a catalog of those full classes on there as well. Certainly give us a call, share, like, do all those wonderful things. I appreciate you viewing the class. We'll see you next week.